What is a FICO score? Or another way to put it is, what kind of risk am I taking on this person? A computer generates a number based on one of your reports from either Experian, TransUnion, and Equifax, and spits out your credit score. This number can range from 850, which is a perfect score, all the way down to 300, a perfectly terrible credit. However, with these several different flavors of credit scores, FICO has turned their algorithm to give out a mortgage score, an auto score, a bank card score, and so on. Even more, your score in any of these categories will be different depending on which bureau originated it. Your TransUnion score will be different from your Experian score. 5 factors affecting your score. Number 1, your payment history, which makes up for 35% of your FICO score. Naturally, the biggest indicator of whether someone will pay their bill on time is how well they've done so in the past. Some of the best credit scores have extremely long history of on-time payments. This means that missed payments, delinquencies, collection accounts, judgments, and other marks affect your score negatively. While they hurt your score though, they do not permanently. Bad marks fall off at the 7-year mark. Unfortunately, paying utilities, rent, and other bills don't contribute to your score. These accounts do not account for lines of credit, so FICO doesn't consider them. However, if they do get passed on to collection agencies, they will affect your score negatively. So if there's one thing to know about this category, it's always to pay your bills on time. Ideally, especially for your credit cards, you want to make all of your statement balances in full every month to avoid paying interest. A side note is an interesting fact about the FICO algorithm is that you need 6 months of history to even register a score. Applicants with thin lines will actually have no score associated with them. Number 2 is accounts owned, which makes up of 30% of your FICO score. This category is somewhat complex, and it generates a lot of confusion when discussed. It's also called credit utilization. This includes the following subfactors in varying amounts. The total amount of credit available versus the total amount of balances on revolving accounts. The amount of credit available on individual revolving accounts versus the individual balances. The original loan amount, the number of accounts owned, the number of accounts with balances. Your utilization credit is calculated using the most recent reports from your financial institutions. Since most banks and credit unions report the statement balances to the bureaus, you can safely assume that your most recent statement balance is what your score is based off of. One important thing to note is utilization does not have a history. There is no average utilization. It is solely based on the most recent reports from your financial institutions. So it is really only a snapshot of your liabilities and can improve or crash in the span of less than a month. It's generally advised that you can ignore utilization until a month or 2 before applying to a new line of credit. Generally speaking, if you're above 30% of your credit limit, a lender may consider you to be high risk. A statement with 30% utilization will hurt your score until a lower balance is reported. This is only a short-term problem, however, because utilization has no memory. It logically follows that paying down debts and keeping balances low will increase your score. The lower your balances, the better your score. So credit utilization means the total amount of credit, meaning if my credit card has $15,000 versus the total amount of balances. So my total credit cards have a total spending power of $50,000, meaning if I wanted to, I can go out and I can spend $50,000 on my credit card. So the bigger that number is, the bigger spending power that you have with your credit cards or line of credit anywhere, whether you're doing a house, whether you're buying a house, whether you're buying a car, the bigger that amount of available spending that you have, the better. Versus the total amount that you're actually borrowing. So if you did go out and spend $10,000 out of that $50,000 that you can spend per month, the bigger that $10,000 number that you spend per month and do not pay it off, your revolving balance. So that means you don't pay your balance off in full each month. You pay off the minimum or whatever else. So that $10,000 of revolving debt that you have is bad for your credit. It will lower it for the month or two that you have it until you can pay it off. So the sooner you can pay that off, the better. The total amount of credit available versus the total amount of balances on revolving accounts. The amount of credit available on individual revolving accounts versus the individual balances. The original loan amounts on installment accounts versus the current loan balance. The accounts owned and the number of accounts with balances. Number 3, your length of history. This accounts for 15% of your FICO score. This category takes into account, among other things, the following information. The age of your oldest trade line. This, for example, could be the oldest credit card that you have. In my experience, I opened up my first credit card in 2006. So this is the age of my oldest trade line. Age of your newest trade line. I opened up an account in 2013. That's my newest credit card account that was opened in December 2013. The age of your average accounts. It's fairly straightforward to think that the longer you have been managing credit, the more experience you have keeping in time with payments and dealing with financial institutions. Therefore, you are seen as a lot less of a risk. All trade lines, open and closed, will contribute to your average age of accounts. Closed accounts will continue to contribute to your average age of accounts until falling off at the 10-year mark. Number 4, the types of credits in use. This accounts for 10% of your FICO score. Consumers can benefit from a diverse mix of accounts. A combination of installment and revolving credit will boost a score slightly, since the lender knows that the consumer has dealt with different types of trade lines. In addition, the number of each account is factored in. If it's not, however, necessary to take out a loan simply to boost this category, is actually detrimental to some degree. Credit cards are the sufficient tools for building credit history, and this category will take care of itself in due time. Never take out a loan simply to boost your score. Finally, number 5 and the last one, credit-seeking activity. This accounts for 10% of your FICO score. FICO figures that, statistically, consumers that seek out lots and lots of credit in a short amount of time tend to be at higher risk. This is reflected in the score to some degree, as you can expect. When you apply for credit to be extended to you, it typically results in something called a hard inquiry. Hard inquiries by themselves are not that big of a deal. For most credit files, your score will take a hit of less than 5 points. A hard inquiry will continue to affect your score for 1 year and will fall off your report entirely after 2 years. The only warning here is to avoid too many inquiries in a short amount of time. Sometimes, for information and other general purposes, some companies will pull your credit report without the intent to extend your credit to you, resulting in something called a soft inquiry. While you may see many soft inquiries on your credit report for up to 2 years, soft inquiries do not affect your score, and lenders do not consider them. So while it's common for lenders to offer pre-approvals for credit cards or loans, this does not affect your credit-seeking activity, since you are not applying for the credit.